Are you still picking individual stocks hoping to retire early, only to watch your portfolio swing wildly every time the market tumbles? What if the strategy you think is building your wealth is actually slowing you down? Today I'm going to break down why most people chasing early retirement are quietly switching their approach, what index funds actually are, and how they work, how to know when stock picking might actually make sense, and how to build a diversified strategy that fits your life and your goals. Stick around because this one could literally change how you think about your money. Let me start with something real. When I first got into investing, I thought picking stocks was the move. Everyone around me was talking about the next big company, the next Nvidia, the next Meta, and honestly, it was exciting. Watching a stock you picked climb 40% in a month felt like pure genius until it did not. I remember doubling down on one stock I was convinced was going to keep running. It crashed. And that sick feeling in your stomach when you realize you just lost a serious chunk of real money, that feeling stays with you. But here's the thing I want to be upfront about from the start. This is not an anti-stock video. Individual stocks are not the enemy, and you absolutely can buy both. The real question is, are you stock picking with a strategy, or are you stock picking on hope? Because here's what actually separates successful early retirees from people who stay stuck. It is not whether they picked the right stocks. It is whether they built a foundation that does not depend on them being right every single time. That foundation, for a lot of people building toward retirement in their 40s, is index funds. So let us talk about what those actually are. An index is basically a list of companies that represents a slice of the stock market. The S&P 500, for example, tracks the 500 largest publicly traded companies in the United States. Companies like Apple, Amazon, and Google are all in there. An index fund is basically a basket that holds all of those companies at once. So instead of betting everything on one company, you own a tiny piece of hundreds of them. The biggest advantage here is that you are not trying to be smarter than the market. You are just riding with it. And over long stretches of time, markets have historically gone up. That makes index funds incredibly powerful for anyone playing the long game toward early retirement. Now, I know what some of you are thinking. Index funds are slow. They are boring. And if you had just put money into Palantir or Nvidia or ELF Cosmetics a few years back, you would have made 4 or 5 times your money. And you are not wrong. That absolutely happened. Individual stocks can massively outperform index funds in certain windows, especially when the market is in what you might call a risk-on season. That is when markets have pulled back hard, valuations look cheap, and the conditions are right for outsized gains. In those moments, being tactical with individual stocks makes real sense. But the key phrase there is knowing which season you are in. Risk on means markets have dipped, prices are attractive, and you are looking at potential upside. Risk off means markets are near all-time highs, things are getting frothy, and it might be time to lock in profits and rotate into something more stable, like index funds, bonds, or gold. Learning to read that market sentiment is genuinely a skill, and when you develop it, the two strategies stop competing and start working together. You ride individual stocks during favorable windows, take your profits, and park them in index funds for the long haul. That is not theory. That is how a lot of disciplined investors actually do it. Now, age and time horizon matter enormously here. When you are young, time is your most powerful asset. Even a modest return compounded over 20 or 30 years creates real wealth. As you get closer to your target retirement age, the calculus shifts. You have less time to recover from big losses, so protecting what you have built starts to matter more than swinging for the fences. One thing that often gets overlooked in these conversations is diversification across asset types, not just within stocks. Index funds are one tool, but annuities, bonds, real estate, and even cash all have a role depending on your situation. Yes, annuities have a complicated reputation, but in the right circumstances, they offer guaranteed income that no stock or index fund can promise. Diversification across all these vehicles is what actually insulates a portfolio from catastrophic loss. Something else worth bringing up is ethical investing. A lot of people want their money to reflect their values. The good news is there are now index funds specifically built to exclude certain industries, whether that is tobacco, weapons, gambling, or fossil fuels. These are called ESG funds, which stands for environmental, social, and governance-focused investing. You can build an index-based portfolio and still avoid companies that conflict with your beliefs. It takes a little research, but it is absolutely possible and increasingly accessible. So how do you actually buy index funds? You open a brokerage account, which is basically a financial account that lets you buy and sell investments. Platforms have made this much easier than it used to be. You link your bank account, transfer some money in, and search for the index fund you want. Some of the most popular ones track the S&P 500 and are available on every major platform. If all of that still feels overwhelming, robo-advisors are another solid option. You tell it your goal, your timeline, and how much risk you can handle, and it builds and manages a portfolio for you automatically. This is perfect if you want to be a hands-off investor. You can start with whatever you can afford. Even small amounts add up significantly over time because of compound growth, which is basically your returns generating their own returns. And that word, automate, is the real secret weapon for anyone building toward early retirement. Set up automatic contributions, remove the emotion. When markets dip, and they will dip, do not panic sell. A dip only becomes a real loss if you lock it in by selling. Investors who held through every rough patch over the last decade are sitting on enormous gains right now because they stayed the course. The honest truth is that there is no single perfect strategy that works for every person in every situation. Some people love the research, the analysis, and the excitement of individual stocks. And if that energy is backed by a real process, it can absolutely generate strong results. Others want something simple, automated, and dependable. Index funds deliver that, and many smart investors use both, intentionally and strategically. What I do want you to walk away with is this. Retiring early is not about finding the one magic investment. It is about building a system that fits your timeline, your risk tolerance, and your actual life. Whether that is 100% index funds, a blend with individual stocks, ethical investing filters, or annuities for guaranteed income, the goal is the same. Make your money work hard enough that eventually you do not have to. Here's a question I would love for you to answer in the comments below. Are you currently a stock picker, an index fund investor, or are you doing a mix of both? And if you are mixing, how do you decide when to be in stocks versus when to pull back? Drop your answer below. I read every single one, and your experience might help someone else figure out their own path. If you found real value in this video or picked up something new today, please give it a like, subscribe to the channel, and hit the bell so you never miss our latest investing insights. Your financial freedom is closer than you think. Let us keep building it together. See you in the next one.